three small points. I will highlight that. And towards ensuring as well as preserving the financial system stability, the Reserve Bank has been taking many definitive steps. Today, I would like to walk you all through a few of those enabling steps by the Reserve Bank. Number one is a consultative approach to regulations. Globally, and especially in India, regulatory approaches have evolved to become more consultative, incorporating the feedback to develop balanced and effective regulations. The establishment of Regulations Review Authority 2.0 in 2021 is a testament to RBI's commitment to streamline regulatory instructions, reduce compliance burden, and eliminate obsolete requirements, thus fostering a more efficient regulatory environment. Having served as the chair of the advisory group representing the industry at that time, I can personally attest to the regulators' responsiveness and sensitivity of the industry's concerns. The implementation of various recommendations of RRA 2.0, coupled with the tireless efforts of the various interdepartmental groups within Reserve Bank of India, has already led to the issuance of several harmonized, consolidated and updated master directions, as well as withdrawal of over 1,000 circulars, apart from doing away with many regulatory and supervisory returns that have become redundant. These measures have significantly reduced the compliance burden on the regulated entities. The second is pushing for a good governance. History is replete with examples, both in India and abroad, as to how apparently successful business ventures quickly folded up due to poor governance and excessive greed. Therefore, the Reserve Bank has taken up this as one of its focus areas to create awareness as well as to ensure adherence to good corporate governance practices. We are having more frequent and direct engagement with boards and top management of regulated entities as well as self-regulatory organizations. Through these dialogues, we share our concerns and priorities and also strive to understand the challenges faced by the industry so that the appropriate regulatory measures can be taken up. The third is instilling a culture of compliance. An essential element for sustaining longevity of financial institutions is that a culture of compliance should prevail across the institution. The recent direct engagement with the heads of assurance functions as well as CFOs and auditors by Reserve Bank is testimony to our efforts to strengthen the internal defense mechanisms within our financial institutions. The independence and professional conduct of assurance functionaries, strongly backed by the board and top management, is essential to preserve this culture. I am glad to share with you that these initiatives have been very well received, and I would like to thank the heads of our financial institutions for prioritizing these initiatives in their organizations. So having spent some time on how we have played an enabling role, I would like to shift to highlight how industry is cyclical, including finance. The financial industry, like any other sector, experiences cycles, and it is currently riding a high wave, as all of you would agree. Therefore, this is the right time to strengthen our institutions, enhancing their financial and operational resilience, and ensuring the long-term stability of our financial system. For those wondering why now, I emphasize that taking decisive action now, even if it means swallowing some bitter pills, is crucial to ensuring our financial institutions remain strong enough to support the national goal of becoming a developed economy by 2047. It's not only important to simplify, harmonize, and rationalize or modernize, but also to strengthen the regulatory and supervisory framework. Recent drafts on expected credit loss, project finance, and liquidity coverage ratio exemplify this approach, aiming to reflect the needs of the industry while seeking to step up financial strength and stability. And the third part of my speech I thought I would cover as to how RBI has been in the forefront of innovation. The RBI has undertaken several initiatives to support the development of digital public infrastructure and establish robust institutional frameworks complemented by various policy measures aimed at enhancing the financial sector. In 2019, the RBI introduced the regulatory sandbox framework to provide a controlled environment for testing new financial products, services, or business models with real customers under the regulatory oversight. This initiative facilitates collaboration among regulators, innovators, and financial service providers to assess the benefits and risks of emerging technologies. Since its inception, 5 cohorts of the sandbox have evaluated various ideas, with some of them proving to be feasible. To address situations where a product or service might fall under multiple financial sector regulators, an interoperable regulatory sandbox mechanism was also introduced in 2022. Complementing these efforts, the RBI has also organized global hackathons under the Harbinger initiative, which not only rewards winners generously but also provides stipends to shortlisted teams to support the prototyping of their solutions. The third edition, Harbinger 2024, themed Innovation for Transformation, invites solutions aimed at achieving zero financial frauds and creating Divyang-friendly technologies. In 2021, RBI established the Reserve Bank Innovation Hub, which has been instrumental in advancing digital solutions, such as fully digital and streamlined delivery of Kisan Credit Card farm loans. Last year, it launched the pilot on public tech platform, now more famously renamed as ULI, designed to facilitate frictionless credit by enabling seamless flow of digital information to all lenders. This platform features an open architecture and open application programming interface, allowing financial sector participants in a plug-and-play model. So the fourth part of my speech is I thought I would take to some of the commentaries that we hear. Having covered extensively on some of the initiatives that showcases Reserve Bank as an enabler, I now would like to deal with some commentary of regulatory disruption that plays out in the market, thankfully only by a few, but it is still necessary for us to examine this. One such narrative is that the regulator's actions may curb innovation or intrude excessively into business operations. There is also a feeling that regulators must be more supportive of risk-taking. What needs to be understood is that while businesses can be adventurous and inclined to take on greater risks in pursuit of their goals, their profits, and investor returns, the regulators have the responsibility to protect depositor and customer interest and preserve the financial stability. The role of the regulator is to establish guardrails or a balanced framework that encourages innovation while ensuring that risks are managed prudently. For example, the fintech platforms often provide customers with a seamless, efficient experience. By leveraging digital public infrastructure, these platforms can reach a wider customer base, including those who previously had limited access to financial services, thereby advancing financial inclusion and empowering the underserved communities. They help in reducing the cost of customer acquisition as well as transaction cost. Digitalization also allows banks and NBFCs to leverage data for greater insights into their customers' requirements and behavior, which can be used for developing bespoke products, apart from facilitating better risk management and compliance. Reserve Bank has been playing an encouraging role all through such initiatives. However, this digital shift also introduces risks that must be properly identified, mitigated, and managed to maintain a stable and secure financial ecosystem. The integration of disparate entities delivering a digital product often results in complex structures with overlapping responsibilities. In many instances, the actual lender may not even be visible to the borrower, despite regulatory requirements for full transparency. While fintech platforms drive innovation and revenues, credit and operational risks, along with consequent losses, if any, still primarily rest with the regulated lenders who collaborate with these platforms. This can create a disconnect between the service providers and those bearing the risks, leading to potential vulnerabilities for the individual lenders as well as to the financial system. For instance, while loan sanctioning and disbursement have become increasingly digital, effective collection and recovery still require a feet on street and an empathetic approach. Many fintech platforms operate on a business model that involves extending small value loans to customers, oftentimes with poor credit profiles. Unfortunately, this is often followed by aggressive recovery tactics, such as invading customers' privacy by accessing their contacts and personal data. These practices can seriously damage the reputation of the regulated lenders associated with these platforms. According to RBI regulations on outsourcing, even though a regulated entity may rely on third parties to perform certain activities, it remains ultimately accountable for the actions of its outsourced agents. Another narrative I would like to address today is the perception that supervisors are overly eager to impose business restrictions, sometimes being portrayed as trigger-happy. This misconception creates an impression that regulators are constantly looking for opportunities to clamp down on financial entities. We are sometimes asked by the media, some of them who are here, who is next, implying that supervisory actions are routine in nature. In reality, the decision to impose business restrictions is never taken easily. Strong supervisory actions are brought in only after careful on-site examinations, off-site data analysis, and extensive engagement with the regulated entities concerned for remediation, oftentimes stretching into several months. Our primary goal is to ensure the stability and integrity of the financial system and not to hinder business operations. Out of over 150 banks, over 9,000 non-banking financial companies, about 1,500 UCBs, and various other entities that we supervise, stringent actions have been taken only in a handful of cases. That too, the most outlier in each category has been called out for such punitive actions so that it has a demonstrative effect on the rest of the industry. These measures are not about penalizing, but rather about protecting the interests of depositors, customers, and the broader financial system. Despite these efforts, it's disheartening at times to see innovative misinterpretation or intelligent interpretation of regulations. A recent case in point is that of peer-to-peer, the P2P lending regulations. The regulations as originally conceived, I'm sure some of you here would certainly know, the regulations as originally conceived envisaged the platforms to function like online marketplaces connecting lenders with borrowers, with no credit risk borne by the platform and no commingling or retention of funds by them. However, the supervisory findings over the last 1 year revealed that some of these platforms adopted practices which were violative of both letter and spirit of the regulations. Instructions issued earlier this month on P2P lenders are nothing new, but are merely responding to the egregious violations observed in some cases. However, it is being presented in some quarters as if these new regulations will kill the industry. On the contrary, the differentiated licensing and light touch regulations that were granted to such entities are intended to help them set up a unique platform and not mimic banks and NBFCs that are more robustly capitalized and more stringently regulated. So in conclusion, despite occasional brickbats, the regulatory frameworks have been adopting a consultative approach which has helped shape a resilient financial sector. Over the past few decades, the Indian banking sector has navigated many challenges, including the Asian financial crisis, the global financial crisis, and most recently the COVID-19 pandemic. Each time, the Indian financial sector has emerged stronger. about which we are all very proud of, thanks not only to the efforts and the adaptability of the industry, but also to the prudence and foresight of the regulatory framework. All of us are partners in this journey towards realizing the vision of Viksit Bharat 2047. However, dreams cannot be built on weak foundations, which is why it is the regulator's responsibility to set up both enablers as well as guardrails that will ensure that we reach our destination safely, securely, and keep going.